All right, so today I wanted to make a video on dividend investing. This is very popular, especially amongst younger people. Covered call ETFs have grown massively. Like they basically did not exist 5-10 years ago. For sure 10 years ago, I think is kind of right around when QYLD came out, but right around 4 or 5 years ago is when they started to become popular, and I think that really set the stage for a whole new way of investing. Now, when it comes to dividend investing, if it's done right, I think that it's just a different version of value investing. They're obviously not the same, but they are similar. And there's a lot of things that I think people get wrong when it comes to dividend investing. Namely, they chase yield and not overall returns. The other thing too that I think people are wrong about is that there's some people on the other end of the spectrum that say dividends are overrated, and I completely disagree with that as well. I kind of fall into the middle in that I really like dividends. I like companies that pay lower dividends but are growing them consistently. That's what I like, because I don't plan on needing money to live off tomorrow or even a decade from now. My plan is, ideally, a decade from now, that would be nice to retire, but for most people, and me as well, that's probably not realistic, right? It's probably not realistic for the vast majority of people to go from just getting into investing to retiring off their investments in a decade. Usually that's a 20, 30, 40-year process. So that's a very important thing to keep in mind. So given that, the key is dividend growth. So let's get right into it here. If you're wondering about ETFs, this is another thing that people bring up is, is there an ETF? And a lot of people like SCHD because it pays a higher dividend. I think it's like 3.5%. It's growing at all right, but the problem is that it's underperformed, especially recently over the last few years or so. It's clearly underperformed, and that's because I think it holds some questionable names in there. As far as if I were to hold one ETF, at least a dividend one, it would be VIG. And that's because if you look at it, number one, it's an $83 billion assets under management. So once you get 100 shares, you can start selling covered calls, no problem. There'll be lots of liquidity there. Again, it only pays a 1.74% dividend. So people are saying, oh, that's pretty much the market average. What are you talking about? But if you look at its long-term growth here, over the last 10 years, it's grown that dividend over 8% per year, and over the last 5 years, actually 13%. So you're looking at about let's say 10% growth per year. That means that you're going to be doubling your yield on cost every 7 years, roughly. So if you were to put money in today, the yield on cost 7 years from now is going to be about 3.5%. 14 years from now, it's going to be about 7%. 21 years from now, it's going to be about 14%. Now, again, that's only money you put in today, not obviously down the road. But that's the power of dividend growth as opposed to simply buying a regular dividend stock. If you look at this ETF, it has slightly underperformed the S&P, although it's not that significant. We're talking maybe 1 to 2% per year. But it's going to be a little less volatile. If you look back in 2020 here, it dropped less. So the good news here is that it's going to do it in a less volatile manner. If you look at its historical yield on cost, this is exactly what I'm talking about here. 10 years ago, if you were to buy it, your yield on cost would be right around 4.3%. If you go back, I don't know if it was around in 2004. No, it wasn't. So the furthest back it goes looks like the summer of 2006. Your yield on cost will be just below 7%. However, if you bought it, back in 08 or 09, you'd be over 10%. So that's what I'm talking about when it comes to these companies, when it comes to ETFs, is that ETFs and companies like this are better because if your goal is long-term growth, this is the way to go, because you get the best of both worlds. You're going to get a higher dividend yield if you simply hold it for a long period of time, and you're going to get the growth. And something that I don't think enough people take into account is that if you have, let's just say you have your entire holdings in an ETF that just pays a straight up straight up a 10% yield, and you have $1 million in there. So you're getting $100,000 a year pre-tax. Well, the problem with that is that if they don't ever grow their dividend, and let's say you retire at 50 and you live to be 90, well, that's 40 years of inflation that's going to be accumulating along those lines, right? So if inflation's going at 3% per year, that means that, prices are going to be doubling, roughly every, for sure prices are going to double over that period of time. So, by the time you're in your 70s and 80s, all of a sudden you're going to be making equivalent to $50K a year, which is not enough to live basically anywhere. I mean, 100's not enough to live in a lot of places. So that's the problem with ETFs and with companies that don't have any dividend growth, is that if you want to retire off them, it's kind of hard to do that knowing that you're going to get no growth. Now, theoretically, you could just save a little bit extra and just reinvest 10 or 20% of your dividends to maintain that, but that's not necessarily ideal either when you could get the growth and the dividend all in one. And that's another reason that I like an ETF like this, is that the longer you, let's say you stop and retire, well, your yield on cost is still going to keep going up. So not only are you going to be able to retire and know, but also you're going to know that the amount you're going to be getting is going to be going up over time, which will make up for inflation. And I mean, if it's growing at 8 or 9 or 10% per year, you're going to beat inflation. And that's not even including if you sell covered calls, which will help out even more. So that's my whole point when it comes to dividend investing, is that let's give some examples here just so I can kind of make my point, right? Arbor Realty Trust, that's one of the big mortgage REITs, or one of the more popular ones. You look at the dividend here, 12.7%, but underperformed the S&P. Actually, over the last decade, it's outperformed the S&P, but let's check the last 5 years. The last 5 years, it has underperformed. The last 3 years, basically actually slightly underperformed again. So that kind of shows the point there as well. If you look at, a Realty Income's another good example of this. This is one of the more popular because it pays monthly. Grossly underperformed the S&P over the last decade. If you look at, what's another popular one? Altria is a popular one that I know people have money in because it pays like a 7% dividend. Also grossly underperformed the S&P here. There's a lot of these. What's another popular one? I'm going completely off the top of my head here. AT&T is another popular one. This one's I think a great example of a dividend trap. They've cut their dividends several times. Grossly underperformed. I think at one point they had like a 7 or 8% dividend. They're down to about 5% because they've had to cut the dividend. So that's another example of it. I could go on forever giving these examples, but my whole point here is that you want to be very careful when it comes to some of these companies that pay very high dividends, because they pay a high dividend, but you want to look at the overall return. Because if a company is paying a 10% dividend, but the share price is going absolutely nowhere, versus an ETF that's getting 11 or 12%, well, you're still losing out. So that's something to keep an eye on. Another thing that I forgot to bring up here when it comes to some of these companies is that a lot of these companies, I'm not sure if Arbor is one of them. Yeah, they are. Look at their shares outstanding. The shares outstanding have gone up 4 times in the last decade. They've gone from 51 million and change to 218 million and change. So these companies are literally paying for that dividend because they're simply just issuing shares. Like that's one of the main reasons that they're getting such a high dividend here. They're just issuing shares. So you have to be very, very careful with that. When it comes to these companies, look out for that. So there is some good examples of some of the higher dividend companies, ETFs and stuff. But let's look at QYLD. QYLD is probably, I think it is the most popular covered call ETF, but they've underperformed by a lot as well. And I think that covered call ETFs, if done right, I mean, covered calls, when done right, is a very effective strategy. The problem with a lot of these ETFs is that they do a terrible job of it. QYLD is an example of that. I mean, they've half the S&P returns over the last decade, even though, again, 11.8% dividend. Oh, it looks so great. So you got to be really careful here. I think there's some that are better. JEPQ is definitely a little bit better. JEPI is not as good, although I know they're more popular. Dividend yields just under 10%. Since inception, this ETF's only been around for about a little over 2 years. They're almost the same as the S&P. And that's basically what I'm looking at when it comes to these companies. I do have some exposure, a small amount of exposure to these. Not because I think they're the greatest investments ever, because I do want to build up kind of a buffer of roughly, give or take, maybe $500 a month from some of these ETFs and companies, because I think that it would be nice to have kind of as like a secondary emergency fund. You have your regular emergency fund, and then you have this that would help pay for bills in an emergency. Other ones, I know that there's some newer ones that have came out. XDTE is a weekly covered call fund that has done fairly well. I don't even know if it's been around a year yet. No, it came out in March of this year. But if you look at it here, it's actually outperformed the S&P by about 1%. But again, we're only looking at a 6-month time period. This one pays weekly, which is what makes it very interesting. I have bought a little bit of this one. Although, again, if you look at the share price, it's actually gone nowhere, but with the dividend, it's actually up. So that's one that I do have a very small position in. I'm kind of intrigued by the weekly dividend. The one thing when it comes to these companies and everything else when it comes to investing is that don't be afraid to drop them. This is a mistake that I think a lot of people make, is that they become too wedded to their positions that they're too afraid to sell. Now, I'm not saying you sell anything just because it underperforms for a short period of time. That's not what I'm saying, but don't become too wedded to your positions. If you're looking for oil and gas names as well, EPD, I think, is a good one. Enterprise Products Partners, they pay, I think, about just over 7%. They didn't even cut their dividend back in 2020, which is what I think makes them pretty good. There's a lot of these. SPYI, I think, is one that does the covered call thing or strategy better than the QYs and the XYs of the world. This one's been around for just over 2 years. It has underperformed the S&P, but if you go back this year, let's try just this year because I want to see that. So just this year, they're actually about a 3% difference, which is not crazy, but being up 13%, I think, is still solid. So that's another one that I think is solid. There's a lot of them. I could go on for a while with these kind of ones. My criteria for these is quite simple. I want them to be close to keeping up with the market. But when it comes to my long-term holdings, the ones that I actually have a higher conviction and much larger positions in are companies like EQB, which I've talked about a million times. They're a great example of what I'm looking for. You have a payout ratio below 20%, a dividend yield below 2%, but they're growing it by 20-30% per year. That's exactly what I'm looking at here. Another good example from Canada, Go Easy is another good example. Payout ratio is 29%, dividend yield 2.62. They're growing it about 30% per year. Also outperform the S&P. Visa might be another great example of this. I didn't get into it earlier, but one of the main reasons that I really like dividend stocks is the predictability of them. In that, if you look at a company like Visa, well, they've grown their dividend every single year, going back to, as far as it goes back here, 2008, they've grown it every single year. And again, the yield's below 1%, but the payout ratio is 21%. So, like I've said several times already, the current yield is irrelevant to me. The most important thing is what's that yield going to be 10, 20 years from now. And if you look at Visa, 10 years ago, the yield was about 4%. And if you go back 2008 is as far as we can go, it looks like here. The yield was almost 12%, right? Almost 12%. I mean, there was a point in time where it was over 15. So this is a perfect example of what I'm looking at here. Obviously, these kinds of examples are few and far between, but most of the companies that I own, most of the companies that I talk about fall into a category similar to this. One last thing I will reiterate here is a lot of the ETFs also, I think, do an underrated job of this. Let's look at the NASDAQ ETF. This is another good example of this. Current yield 0.64%, but the 10-year growth rate is about 12%. The 5-year growth rate is almost 13%. If we go back a decade, you would have a yield on cost of right around 3%. And if we go back 20 years, this one's actually 20 years ago, it would be about 7.5%, almost 8% on the NASDAQ. So that's why I think that although a lot of people like buying individual stocks, I think that buying ETFs also is an underrated strategy when it comes to dividend investing. If you're in your 20s, like I am, and you can buy an ETF like this, knowing that as long as the future, I mean, again, past returns don't guarantee future returns, but when it comes to a typically they are fairly similar, right? So let's just say it's even 10%. If you could have a yield on cost of 7% on the NASDAQ 20 years from now, who in the right mind is not putting at least a proportional amount in their portfolio for that? So the last thing I'll leave it on here is don't be afraid of the market, just like your S&P and the regular just market ETFs. If the last one I'll bring up here is RSP. Actually, I'll talk about SPY as well, just to compare. RSP, if we go back 10 years, pretty similar, about a little over 3%, so just a tiny bit more. If we go back 20 years, about 7.5%. So it's almost the same, right? It's almost exactly the same. If we check out SPY, this is the last one I'll talk about because I think I've made my point clear enough here. But the last one, SPY, again, the most popular ETF in existence, I believe. They haven't grown as fast, but let's just check it out just out of curiosity. 10 years ago, you'd be looking at, again, 3.5% roughly, and 20 years ago, we're looking at, this one's about 6% roughly. So ironically enough, I'm not exactly sure. Obviously, there's a reason behind it, but SPY is actually the least. You'd actually have a higher yield on cost if you bought the NASDAQ than the S&P. So that's one of the reasons why I do prefer the NASDAQ ETF over the S&P ETF because the growth has been better and the dividend's going to be higher in the long run. That's also why I buy RSP, because not only is the dividend going to be higher, but you actually get more diversification there than SPY or even obviously the NASDAQ. So like I mentioned earlier, this is kind of the truth when it comes to dividend investing, is that don't get caught up on the current yield. You want to be concerned with two things: the future returns and the future yield. That's what you want to be concerned about. So if you got value out of this video, please like, comment, subscribe, all that good stuff, and stay tuned for more.